Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a real estate investor, advisor, and coach, as well as the founder of Streamlined Properties and the team leader of Streamlined Properties on Market, brokered by eXp Realty. Whether you are looking to start from scratch, get to the next level, or just a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another week of Zen and the Art of Real Estate Investing. Before we get to our amazing guest for this week, I just wanted to remind you that if you're enjoying the show and feel that it adds value in the real estate investing space on podcasts, be so kind as to leave us a 5-star review, subscribe, share it with your friends, do all the things that will help us grow and get our information out to other like-minded folks like yourself who are looking for a more mindful approach to real estate investing. With that said, this week's guest is Tom Wheelwright. He's going to knock it out of the park. This is a tax-friendly episode. Tom's a global speaker on tax and wealth strategies and a Rich Dad advisor. Yes, that Rich Dad from Rich Dad Poor Dad. That's it. You need to get ready. It's a book that everybody's read, and Tom is an advisor to Rich Dad. Let's go. This is episode 42 of Zen and the Art of Real Estate Investing with my guest, Tom Wheelwright, who is an entrepreneur, best-selling author, Rich Dad advisor, and international authority on tax. You might have read his book, Tax-Free Wealth. It's all over Amazon, and also his new book, Win-Win Wealth Strategy, also a Wall Street Journal and USA Today bestseller. Tom, welcome to the show. It's great to have you.
Thanks for having me. It's great being with you, Jonathan.
Yeah, I suppose you get these questions all the time, like people don't know what they're doing with taxes and real estate investing. Is that what you found over your whole career now?
It is shocking. Actually, I run into developers, syndicators who've been doing it for years and still don't know what they're doing. So I'm like mystified.
Yeah. Do you think it comes from a lack of education on the tax side that people get interested in making money but not protecting money?
I think some of it's, a lot of it's a lack of education, and a lot of it is simply being lazy. Frankly, I think that some of it's just, that would require work on my part. So why would I do it?
Yeah, it takes a little bit to figure out the best way to do it, and we'll definitely get into it. But yeah, I mean, I think of myself, my dad used to work for the IRS, and I grew up like investing with him. He knew all this stuff, but I like when he would try to explain it to me when I was learning, I was like, same, like you're saying. I'm like, that sounds great, but like, let's just go look at the properties and buy. I don't want to know that stuff. But you've built a career on figuring out how to tell people where they've been losing out for years and years on their money. Mm-hmm. Do you find that people are aggravated with themselves after you unlock the secrets for them?
Oh my heavens. I'll hear them say, well, I wish I'd heard this 10 years ago. And I'm going, you could have read my book 10 years ago. So it's not like I'm 30 years old here.
Yeah.
I do get that actually quite a bit. And then there are other people that they just weren't ready. They just weren't ready to hear it yet.
Yeah. And I think people think of taxes as complicated anyway, and they always want to outsource it, obviously, to their regular accountant. But your general accountant does not understand the intricacies of real estate investing and the way that you can make money off of debt, what you've said.
Yeah. It's not just that, Jonathan. It's actually that you can't outsource it. It has to be a partnership. One of my favorite sayings is, if you want to change your tax, you have to change your facts. I can't change your facts. I can tell you what to do, but I can't do it for you. The question is, how willing are you to be a partner? How willing are you to make investing a team sport, which is what it really should be?
Yeah. And generally, it makes sense to me. But I think for the listeners, why does it have to be such a cooperative entity? Is it because of the investments and the way that you use them in order to maximize your tax benefits?
Yeah. Interestingly enough, years ago, we've been doing tax strategies for 30 years. But when we first started out, we kept asking people, okay, so what are you going to do with your money? And they'd go, I don't know. How you invest your money has a major impact on how much tax you pay and what we need to do. So, for example, okay, there's a big difference between a limited partner in a syndication and the developer, right? Or somebody who does their own investing in real estate. They're going buying fourplexes or their duplexes or single family homes, whatever. And there's just a big difference in how you do that. If you don't know what you're doing, I don't know what to tell you, because the law is very fact specific. And different people get treated different ways based on their facts. And everybody gets treated the same if they have the same facts. But that's the problem. It all comes down to, are you willing to change your facts? Are you willing to do the things that need to be done in order to reduce your taxes?
Yeah, and I think it's an important point you made. The law is the law. There are standards there, and there's interpretations of law. I was a lawyer, I still am, but I spent years, you have the law, and then it gets interpreted in different ways, and that's where smart tax strategy comes in. So you created something called the wealthability system, which is also, you have a show on that as well. So do you want to give us an overview on what that is? If someone comes to you and says, help me, obviously you have to know what they have, but what's the wealthability system about and how do you apply it to clients?
Yeah. So we decided a number of years ago, rather than have a single CPA firm where we could only serve a limited number of people, we develop a network of CPA firms and tax advisors. So now we have 65 firms across the US and Canada, and we're continually expanding that. And so that allows us, first of all, to take anybody from a brand new investor to somebody who's a very sophisticated investor, like, the clients that I handle. And then second of all, what I've looked at is I've looked at the tax law so long that I recognize the patterns in the tax law. And if you have patterns, you can develop a formula. And if you have a formula, you can develop a system. And so what we've done is CPAs are not very good at coming up with new ideas. It's not their strength, but they're really good at following a system. So we train our CPAs. It'll take them anywhere from 3 to 6 months before they even qualify to take on a client that comes through us, because we want to make sure that they are following our system, because they're not better CPAs than anybody else. They just have a better system and a better network and better training. They just have a better group of people around them and better system around them. And on top of that, we have software that we developed just for this purpose. And we just take them through 10 simple steps. And once you get through it, if you do what you're told to do and you do what comes up, you're going to make more money and pay less tax. It's pretty simple.
So the CPAs are being trained to give the best client service within the system, which helps. And real estate investing as a whole, all of the most successful real estate investors have very detailed systems, whether they're doing syndications or huge multifamily on their own. It's all based on systems. I agree with you on that. If you could say, just for your, I don't know, I wouldn't say novice investor, but like for an investor who's just getting started, maybe they have less than 10 units. Where are those people going wrong? Is it in their setup, or is it just in the way of their thinking about assets?
I think it's in a number of things. First of all, they tend to believe that in this, do it. If you want it done right, you need to do it yourself.
Yeah.
I think that's actually the biggest limitation they have, that if you look at real successful investors, they realize that if I want it done right, I'm going to hire people to do it right for me, because why would I want to learn all that stuff?
Yeah.
Right. And so that's actually number one where they go wrong. I'd say number two, and they tend to underhire. So if they do bring in a team, instead of going to a CPA, they go to an EA. Instead of going to an attorney who specializes in asset protection, they go to a general business attorney. I mean, it's just, who do you want on your team? And you can underhire pretty easily. Pretty tough to overhire. And then I'd say that the next thing that you're right. I think how they set up, we find about 50% of your tax benefits are going to come in how you set yourself up. We actually created a software just to draw a picture of how both what your setup is currently and what it should be. And it's a very simple one because we don't want our CPAs taking too much time at it. So our CPAs were using PowerPoint for this. We showed them how to do it. We gave them templates and so forth. But boy, what a waste of time, where now we have software that's just click and drag, and it's really simple. And our system is such that not only can they see it, their CPA sees it, but their attorney can see it, their financial planner can see it, any of their team members can see this information, and it makes it really easy to work together. I think it's really that whole team approach. and taking a little more holistic approach to what you're doing.
Yeah, holistic approach really fits in well. This is about the mindful approach to real estate investing and helping people be a little bit smarter instead of getting caught up in all the hoopla that's out there. There's a funnel for everything, but I think really learning what do people want to get into real estate investing for? They want to make more money so they can get more freedom. So if you can find the ways and systems to help protect your money, make more money, not lose as much money, this is what people need. But like you said, it is complicated. So when you're talking about setup, are you meaning entities or, okay, so LLCs, corporations?
I mean, it starts with bookkeeping, right?
Yeah, sure.
Come on, the most important person in your investing life is your bookkeeper, right? And if your bookkeeper is a relative, you need to fire them and get a real bookkeeper. But then it is your accounting system. So you have to start there because garbage in, garbage out. Second of all, it is the entity. So how do you own your real estate? I've seen too many people, for example, own their real estate in a corporation. I'm going, this is a horrible idea. And whoever suggested it should be sued for malpractice. I truly believe that. It's a horrible idea. There is nothing good about putting investment real estate into a corporate form, whether it's an S Corp or C Corp. On the other hand, putting it into an LLC that's taxed as a partnership, a limited partnership. There are lots of forms that work, and just depending on who you are, but there are certainly forms that just don't work. And so you kick out the ones that don't work. And then, of course, a lot of real estate investors, they have other things going on, right? They're not just real estate investors. They have businesses, which are different entity forms than real estate. And some of them have partners, some of them do it on their own. So it really is that initial, how do I control everything and own nothing, right?
Yeah, right.
I don't want it in my name because that's where I get sued. But I want to be able to control everything.
Yeah, I grew up wondering why I had properties in my name when I was a kid. And then I realized my dad knew what he was doing. I'm like, this is weird. I've owned 30 properties. I'm not even 18. What are all these things? So he was ahead of his time. I wanted to ask you a question, just a kind of a side note. Is one of the big thing that people are missing just in overall tax advantages when it comes to real estate investing? Is there depreciation issues that people don't understand? Because to me, that's one thing that I don't think about enough. I think about it in terms of like other assets. I have friends who are like, oh, I'm going to buy a plane, I'm going to depreciate it. But there's something that's really important about depreciation when it comes to real estate investing.
Oh my heavens, it's shocking. You think about this. If you buy a plane, you're probably going to get some type of debt on it, but a good portion of you're going to put a serious down payment on that plane.
Yeah.
With real estate, you might only put a 10 or 20% down payment on it. And yet you get all the depreciation benefits. The bank gets none of them. And so literally, if you're at an 80% loan to value versus 100% equity, you literally multiply your tax benefits by 5. Instead of getting a tax benefit based on your money, you get one benefit on your money and 4 times on the bank's money. So really, you've got 5 times the benefit as if you just invested yourself, besides having 5 times the amount of real estate. But depreciation is huge, especially right now. We have an 80% bonus depreciation in 2023. Before this year, it was 100%. Mm-hmm. And that is unheard of in the history of the world. Literally, we get to deduct 80% of our land improvements and the contents of the building the day we place our real estate in service. So that could be the day we close if it's already placed in service, right, or it could be the day we finished our development of it and we place it in service. But that's a big number. That can be 20 to 30% of what you paid for the real estate. And if you put 20% down and you get a 25% deduction, that means you're actually getting a bigger deduction than the money you put in.
Yeah.
So the depreciation is huge. People don't understand cost segregation. I find some syndicators that don't do cost segregation just because I think they're lazy, even though they know they should. And they're going, well, my investors don't care. But shouldn't you care about your investors?
Yeah.
Seriously, with bonus depreciation, you can literally double your rate of return simply because the government's paying half of the down payment.
Yeah, it makes sense though, what you said at the beginning and what you just said. It's just a lot of trouble for people to understand. It's why you want to hire pros, but then you have to be proactive because you can't help your best CPA if you're not giving them all the information or you don't even know, how your stuff is held up. That's where I see a lot of people making mistakes. Yeah, I think the episodes like this can really help save people from big mistakes along the way. How did you get into this in the beginning? Obviously, did you have an interest in real estate, or when you first got into the accounting business, you were like, wow, these people are really losing a ton of money?
You know what? Like you, I was very fortunate. My parents were real estate investors. My mother was the controller for my dad's printing company, and I worked for her as a bookkeeper. So I learned accounting very early on, decided very early on that I wanted to go into accounting when I went to school. And then when I was in school, I took a tax class, and that just blew my mind. I'm going, this is so much fun. It's complicated.
Everybody's like, what's this guy talking about? For accountants, get it. Yeah, CPAs get it.
I'm a total tax nerd.
Yeah.
It took me a long time before I would admit that, but I'm a total nerd when it comes to tax. But I don't think tax has to be that difficult. I think it can be fairly simple, because if you look at it if you look at the details and you start with the details, you're going to just be overwhelmed. But if you look at the concepts, and the beginning concept to remember is that the tax law is a series of incentives. And that's primarily what it is. Whether it's energy incentives that Biden put in the law last year, or whether it for renewable energy, or whether it's fossil fuel energy that was put in the 80s, or whether it's real estate that was put in by Ronald Reagan initially, whatever. I mean, that's what it is. So once you start looking at it as a positive instead of a negative, I think that's the first thing. So you talk about mindfulness and mindset. You got to start with having a different mindset about tax. This is not something to fear. This is actually something to embrace, that Congress wants you to reduce your taxes. It's just, in order to do that, you need to do what they're telling you to do.
Right.
And if you're willing to build housing, if you're willing to develop energy, if you're willing to create employment, these are all things, or food, these are all things the government wants done. And once you do that, then they're going to reward you with tax benefits, because they want that. They want to incentivize you to put your money and your efforts there.
Yeah. And I think that goes to the cooperability between client and CPA, knowing, hey, what are your goals? What's on the horizon for you? Okay, now how can we maximize the benefits in advance to make a plan so you actually involve all of them, instead of, I know it's harder once somebody's established and made all the mistakes, then you have to come try and undo them all. You'd much rather have the clean slate. Here's what I'm going to do, and you can help them.
Oh, for sure. Way easier to start from the beginning, way cheaper to start from the beginning. We take somebody on that's already established. It's going to cost 5 times as much to fix it.
Yeah.
Because that's what we have to fix it.
Yeah, it makes sense. So what year did Tax-Free Wealth come out? That was your first book, right?
It came out in 2012.
Oh, wow. Okay, yeah. And so now you're, for that one, over 300,000 copies sold, probably more by now.
Yeah, we're up over 400,000.
I always have a sheet, and I'm like, I know it's going to be more. Yeah, that's amazing. And what kind of, over the years, and at some point you got involved with Bob and Rich Dad, right, along the way, help advise them. And did you feel when you were writing that book that it was just something that like everybody needed to figure out, like an unlocking of the code or something?
Exactly. I'd been around Robert for several years and saw how simple he made financial education. I'm going, I think we can do this with tax, but you have to start with the premise that the tax law is not something to be afraid of. Yeah, be afraid of the IRS. It's okay to be afraid of them. Okay, your dad was an IRS agent, so you know people are afraid of the IRS. Yeah. That's just the way it is. But you don't have to be afraid of the law, because the law is actually written by Congress, not the IRS. And the law is on your side. In the most part, it's on your side. The Congress wants you to reduce your taxes. So, when you start taking a different approach to any aspect of your life, you're going to get a different approach, gives you a different result.
Yeah, absolutely. And I think it's preparation. And I think especially for younger investors, sometimes younger investors are thinking too far ahead, and then we criticize them for that. And it's no, wait, what if you build the structure that you want for later now? You can build the blocks the right way, or else, like you said, it's going to cost 5 times more to come in and undo what you've already done by mistake. And then, so your new book, give us a little bit of info on that one as well, the win-win wealth strategy. Is that like a kind of a new version of tax-free wealth, or something completely?
It's not. It's very different. While it is tax focused, it's also investing focused. What we want to do is just show that, first of all, there's been a lot of dialogue lately about paying taxes are duty, and anybody who reduces their tax, they're criminal. And so there is a large portion of the population that frankly needs permission.
Yeah, great point.
And really, win-win wealth strategy, and the subtitle is 7 investments the government will pay you to make. So we actually go through those 7 investments. And And the goal is to let people know that, look, first of all, we did charts and tables for 15 different countries. So don't believe that this is just the US that does this.
Yeah.
Canada does this. France does this. Australia does this. Literally, we just took a representative countries from around the world in Asia, Europe, South America, and North America and said, look, this is the way it works. And then what we did was say, look, let's focus on the investing side. Don't even focus on the tax side. Okay, so what do you think the government wants to have done? Do they want to create employment? Yeah, they do. Do they want to create technology? Yeah, they want to do that. Do they want to create housing? Oh, yeah, I think they want to do that. What about energy? Oh, yeah, definitely the government wants that. What about food? Yep, they want that. And so you start looking at these 7 investments that the government is just encouraging you to do. The last 2 are very personal, insurance and retirement. But those 2, the government says, look, we want to make sure you feel secure, because a secure population is a docile population, right? So we want to do those things that help you feel secure, which includes retirement planning and includes life insurance and other types of insurance. So there is that security aspect to it. But most of I would say 95% of the law is really for business owners and investors. And all I want to do in Win-Win Wealth Strategy is let people know, look, not only do you get to reduce your taxes, but the government makes money. The government actually makes more money on things they incentivize than things they don't incentivize. The government does not make money on your retirement plan, which, by the way, is the one thing that people feel okay about, but it's the one place the government doesn't make any money. The government makes a ton of money on business, ton of money on energy. The government's actually your business partner, and they're just saying, look, if you invest this way, not only will you build massive amounts of wealth, which is great, but you'll reduce taxes and you'll do things that the government wants done. So it's very much a win-win strategy, which is where the title came from, that we want you to know that the government wins too. It's not just you who wins. It's the government that wins as well. And that it's really about building wealth and less about making money. And I think there's a big distinction there. People are really anxious and interested in making money, but very few people recognize that the more money you make, the more income you earn, the more tax you pay. But the more wealth you build, the less tax you pay. It's that kind of dichotomy that we want to focus on in Win-Win Wealth Strategy.
Yeah, 2 things. I love win-win is a word that I use in off-market marketing all the time, because I think it really tells a story of what you want in all kind of negotiations. Do both parties on each side feel okay about what's happening? So in your book, it's the government on one side, and they're telling you, these are the things that are a win for us, and we'll give you a benefit if you do that. And I think that in real estate investing, that's really the mindset that we should all have. If both parties can agree that we're going to win, then it's going to feel better. And there's going to be, like you said, less stress, less distrust around the process of real estate investing, where I guess sometimes the outward opinion is like all landlords are slumlords and everybody's stealing the money, when it's not. It's like, this is a lot of just family businesses that grew very steadily over the years.
Oh, and I'm sure you saw this too during the pandemic, but I saw a lot of real estate developers who they put a lot of money into helping their tenants get through the pandemic. Yep. I had one of my clients that is a big real estate development developer in Texas, and they actually created a charity during the pandemic specifically to help tenants of all, not just their tenants, but help tenants pay their rent if they couldn't pay their rent. And what I found over the years is that if you pay attention to the tenants, you have a lot fewer problems. Of course. So, what's good for what I say is what's good for the customer is good for the business.
Yeah, it makes sense. I think that there's always this overriding broad view of what real estate investing is or does to the country, but it's different. And in my experience, how I grew up and how a lot of people I know, a lot of real estate investors really started just by getting one property, learning things over time, and then, like you said, accruing wealth. And that was the other thing that I wanted to touch on. I love what you said, because money is one thing. Like you said, you earn more money, you're going to pay more taxes. Wealth to me is freedom. And we talk about this all the time. Why do people get into it? They want to make money so they can be more free. Nobody's just going to sit on a pile of money. Sure, maybe they like cars and stuff. That's not everybody's thing. But the goal is to provide for your family and provide more freedom for your life. And over time, this is really what you're helping people do, is create the strategies to get them more freedom and much less stress when it comes to, because like you said, it is daunting. And I really like what you've said about not treating the tax as like this big thing to be scared of. It's there. We know what the rules are. Now let's figure out how to maximize our benefits.
Yeah, I would even add into that. So at Wealthability, we have what we call our Declaration of Financial Independence. And this is our mission. And we believe that everybody throughout the world actually has the right, is entitled to learn to become independent of employers, Wall Street, and the government. And that's by building wealth. That's how you do it. You don't do that by making a big salary. You're never going to do it. You have to build wealth that pays you over and over again, pays you while you're asleep. Real estate's, it's one of those ways that you can do that.
I mean, all the W-2 workers just started clapping their hands because they can stop focusing on that and figure out alternative wealth strategies.
Please.
Like we always say in the beginning, it's great. Keep the W-2. That's what's going to get you the funnel to help you invest in these alternative strategies. But over the long term, your wealth is going to come from those investments that you make. So when you grew up and started to learn about real estate from your parents that way, did you get involved in actual real estate investing when you were younger? And then while you were running these books in your head, you're like, I can see how this is all going to come together.
Yeah, I didn't. My parents, they had, when I was growing up, they had a single family home and 2 duplexes. And that was the extent of the real estate holdings. The single family home they held was the one I was born in. And then when they moved, when I was little, they kept the house and they rented it out. And then they bought these 2 duplexes that they turned into triplexes. Yeah. So I watched them do that. And then I actually watched and I would ask them questions like, okay, how do you make sure that you've got tenants? And they said, we always price it just under the market. And then we put that up there and then they're always full. And then they had tenants. They had one tenant that was there like 30 years, literally the same tenant for 30 years, which makes the maintenance and upkeep really easy, by the way.
I agree.
And so I watched them, but I didn't really get into real estate investing, honestly, until I met Kiyosaki. I'd gotten into the tax side just because my technical expertise is partnerships and real estate is all about partnerships.
Yeah, of course.
And so I got very involved in real estate. Actually, when I was in the National Tax Office of Ernst & Young, and I was in their partnership group. When I transferred out of there after my 3-year rotation, they asked me to come run the real estate tax department in the Arizona office, in the Phoenix office. And so I came and did that. And then I was hired out of there from a Fortune 1000 company who just bought a real estate developer.
Oh, okay.
And they needed a tax specialist in real estate. So my specialty from a technical standpoint has really throughout my career been real estate. And I do love it because I've watched what it did. I watched what it did for my parents. It provided them a nice retirement income. And then when I met Robert, I played his game, cash flow. I'm going, oh my heavens, this is so easy. Let's go do this. My partner, I literally within 30 days, we had our first property.
Yeah.
And we learned the hard way. We did all the wrong things.
It's part of the process, though. You just try to not make the same mistake multiple times to save yourself. Exactly. It's really interesting, though, the story about your parents, because they were so ahead of their time. I feel like my dad was ahead of his time. They were basically doing things that people sell $50,000 courses for now, and they were just doing it. That's just what you did on the block. The millionaire next door basically tells us you don't need to do all this other stuff, but like you can do it. And I think like even the fact that they turned duplexes into triplex and then told you like, okay, price a little bit below, it's just smart. You have more options. That's really good. But you never really got the bug until you met Robert because the game is amazing. And I think the book gets everyone always says Rich Dad Poor Dad when it comes to the book, but the game is very important to understanding how money works and what you can invest in.
Of course, I love the game because it's fundamentally an accounting game, right? You actually have your 3 financial statements, an income statement, a balance sheet, and a statement of cash flow, right? That's your scorecard, which is what it is for the bank, right? That's your scorecard in real life. And I love it. I actually use it to teach our CPAs the game.
Yeah.
I make them play it. I make them play it over and over again. I just think it's a phenomenal game. And I think the most important way to learn how to do real estate investing before you actually put money into it is to play that game.
Yeah, it's so funny because my son is a big board game person. We have like hundreds of board games, and I like have never made him play cash flow. And now I'm like, okay,
oh my heavens.
Yeah, what am I even thinking? He's 21, and I'm like, it's time. We got to do it right now. Today's episode is brought to you by Streamline Properties On Market, brokered by eXp Realty. That is actually my on-market real estate team. We have close to 50 real estate agents in 4 states, primarily in New Jersey and Pennsylvania. We work with traditional buyers and sellers and all investors, no matter what you're looking to do in real estate investing. We have you covered. You can get all the information you need at our website, which is www.streamlined.properties. So over the years, how did you and Robert partner on a lot of things with Rich Dad and the advisory business?
I remember a very specific time. I had just written Tax-Free Wealth. He'd asked me to write it, but I'd just written it. We were on stage at the Paris in Las Vegas. And we'd just been through, right? This is 2011 and 12. And we'd just been through 2008, 9, 10, where we had this major crash. And we were talking about stimulus, right? You kept hearing this idea that this is a stimulus package and this big stimulus package. And I'm on stage and I'm talking to the audience and it's my turn. We've got all the advisors there. And I said, so the tax law is really just a series of stimulus packages, mainly for business owners, investors. And that's when I saw the light bulb go on. He looked at me, goes, really? I said, yeah, that's what it is. After that, we were off. Yeah. We went literally around the world multiple times in the next 10 years and before the pandemic. And it was amazing to learn how to teach with him, to learn, because he's the consummate student. He's never knows enough. He's never learned enough. Literally to this day, we have a weekly meeting where we have to study a video or something that he's brought to our attention, and we have to discuss it in that meeting. So every single week. And it's fantastic. And it can be about the economy. It could be about why is there so much homelessness? You know, whatever it is, we're talking about it because he wants to constantly be studying.
Yeah, and that was part of Rich Dad Poor Dad. I remember the descriptions of him just being there, questioning everything and still doing it.
He hasn't stopped.
Yeah, but it's a great way to learn. And I think that's part of obviously what you're doing with these books. It's, hey, you're going to get the resources in, but it's not like you still need the professionals to help you. But this is like an eye opener for people to say, oh, wow, it could be this easy. Not necessarily easy, but we could be doing this so much smarter.
Yeah. Oh, you know what? I think I've been doing it for 40 plus years. So I do think it's easy. It's not as hard as people think. It takes a little bit of time. I typically find it takes anywhere from 3 to 6 months to get things set up properly. But then you're off and running. And why not? When taxes are your single biggest expense, and especially if you're in real estate, oh my heavens, if you're not taking advantage of the tax law, you're missing half of your return.
Yeah.
Literally.
I hope everybody's hearing that. And you have to at some point say, oh, it's not too far gone. I have to fix it. Even if you do have to 5X it to start, then you, like you said, you're going to create the system that's going to make it easier for every year there on out. For newer investors who are just getting started, do you have any tips that would help them get started the right way so they don't put themselves in a hole early?
Oh, yeah. First of all, don't undercapitalize yourself.
That's a big one.
It's huge because people go, oh, I don't have that much money. I want my money to go to my real estate. So I don't spend money on a good attorney. I don't spend money on a good accountant. I don't set things up right. I go to LegalZoom or some place like that to do things. And it's going to be done wrong. Right. And so they misunderstand that you are getting into a new business and you are starting a business. If it doesn't matter if you're doing single family homes, you're starting a business and you need to you want to treat it like a real business. And the sooner you do that, so you reduce your risk of audit. When you do that, you reduce your taxes, you reduce your headaches, you make your bookkeeping easier. Everything gets better when you do that. But I find that people get in trouble because they undercapitalize and then they start doing things themselves, which is such a waste of your time and energy. Why spend your time doing what you're good at? Spend your time going out finding that real estate or getting the education to know what you're doing. So I always love people like you, Jonathan, who are really taking the time to educate people and giving people a heads up on, look, here's what the possibilities
Yeah, I
are.
appreciate that. And I would liken all of what you just said actually to just, if you micro it down to what house flippers are doing, they do the same thing. They go in and instead of hiring a plumber, they try to do the plumbing themselves
Yep.
and then it leaks. They blow a pipe and then there's a water issue. Or they're like, I could do this electric or I'm going to do the tile myself. And then you end up with a product that's not right, just like a corporate entity that's set up completely the wrong way, or books that are just messy and you're losing all of the things. What about the more experience that they get? Where do you think like the most experienced real estate investors that you end up getting at some point who come to you and say, help me, where are they going wrong on the larger scale, like syndicators and things like that?
First of all, they're underpricing their team. So they're going for somebody cheap, not somebody that really knows what they're doing. One of my favorite books is the Dan Sullivan book, Who Not
Love
How.
that.
It's about who.
Yep.
And who you have on your team makes all the difference. And so you need to level up your team members. And I think that's where experienced people make just as many mistakes as inexperienced people. But it becomes more costly to the experienced people because now you got 100 units or 200 units or 2,000 units. And I'll talk to the people who've done multiple syndications and never done a cost segregation. I'm going, what's wrong with you? My investors are passive, so they don't get those. I'm going, what's wrong with your investors that they don't have better CPAs to be able to take advantage of those passive losses? I'm just like, there's always a way to make as you said at the beginning, the law is available to everybody. It's available. Okay. And the law says, look, not only can you do a cost segregation, you're supposed to do a cost segregation. The IRS audit manual on cost segregations tells you exactly how to do it, what kind of professional you need to hire. There's plenty of information out there, but I find that mostly it's a matter of under hiring and not getting the right team. And then what you do is you get people who are kind of pencil pushers. Yeah. And they're doing your tax return, but they're not really helping you. And then you forget that, wait a minute, could I help my investors? If I help them get better returns by reducing their taxes, how does that help me get more capital? Think about this. So let's say an investor has $100,000, okay? But let's say that $100,000 based on your debt to equity ratio, your loan to value, let's say that $100,000 gets them a $50,000 tax benefit. That means that they really have $100,000 twice, right? Because now they've got that $50,000 from the first deal, they got the $50,000 from the second deal, so they really have $200,000 because $100,000 came from the government. Yeah. So now they have twice as much to give you to invest. So if all you did was spend a little time helping them know who the people to go to, learn a little bit about taxes, and do the cost segregation yourself. Oh my heavens, the numbers are extraordinary.
Yeah, I love that you mentioned Who Not How. It's a great book. And I think if you look at it in there, they're really focusing on who you can bring in someone with expertise to replace you. But the way that I've always seen it is I always want to find the expert. I don't care what it costs, which people think is weird. If I find the person's that's best, I just say, tell me what it's going to cost for the best person. And I think like in the real estate world, everybody's always trying to bargain everything when it's like, don't you just want a professional? Why don't you just want the person who's best at it and just pay for it? Like we always have people just in regular real estate deals. I have a big on-market team and they're like trying to compare attorneys and how much they pay. And I'm like, why don't you just want the best attorney? You know what I mean? If you pay half, then you get what you pay for. And I think people, like you're saying, they forget that over time. And that's what they end up doing in all parts of real estate investing and taxes, and then pay for it later.
No, 100%.
Yeah. Well, I guess we got the new investors and the old investors, but is there another big mistake that real estate investors in general are making out there that they could put on their radar to just be careful of?
Yeah, I'll give you some simple ones. Not doing a home office.
Yeah.
What you're losing half. So here's the crazy thing. You don't do home office, you're losing half of your deduction for your car.
Oh, wow. Okay.
Because think about it. Okay, so let's say you go out to look at real estate, you go out to talk to your tenants, whatever you do every day. That first trip, guess what? It's a commute. It's not deductible. And the last trip home, again, you're commuting home, not deductible. But if you have a home office, your commute's from your kitchen to your home office. And when you come home, your commute back is from your home office to your kitchen. And the IRS actually explains it that way in their instructions. That first and last trip, typically that can be easily half of your mileage.
Yeah.
And you're losing that business deduction because some bozo accountant told you don't take a home office because it's a red flag, right? When the reality is, if you set your entities up right, the IRS doesn't even know you have a home office. There's no form for it. If you're a partnership, there's no form for a home office deduction on a partnership, only on a sole proprietor. So if you set things up right, the IRS is not even requiring you to tell them you have a home office. So there's just these simple mistakes people make, obviously not doing cost segregation. I'll tell you another one. Real estate professional.
Yeah,
people go,
that's a big one.
Well, I can't, real estate professional, first of all, it's you or your spouse, right? So maybe maybe you're full-time in your employment. Maybe your spouse is staying home with the kids. And all they have to do is put 750 hours a year. That's 15 hours a week. Now, that's a good one. But what if you can't be? What if you're going, I'm never going to be a real estate professional? I will tell you, my wife and I are never going to be real estate professionals. We both have full-time gigs. We like our gigs and we're good at them. And my wife runs her own CPA firm. I run several businesses. And so we're not going to do that. Does that mean we're not going to get our depreciation from our cost segregation? No. It just means you have to change the way you think about it. So instead of thinking about, I'm going to turn my losses from passive to active, which is what a real estate professional does, I'm going to turn my income from active to passive. That does the same thing, has the same result. Okay. But for some of us, that's easier than doing the real estate professional. Yeah. On top of that, remember that now we have this excess business loss limitation. So you can only offset $500,000 of non-business income, like salary, interest, dividends, retirement income. Those are all non-business income. That's actually, if you look at Donald Trump's 2020 tax returns, you go, wow, 2021, he's in trouble. Because in 2021, because he had $10 million of interest income. That's non-business income, and his losses were not going to be able to offset that in 2021. That's why he actually said in 2017, when that law was passed, he goes, this is going to cost me a lot of money.
That was it.
That's why. It wasn't going to cost him for a couple of years. It was originally supposed to go into place in 2020, but of course, then we had COVID and all that kind of stuff. So it didn't go into place until last year. But boy, I'll tell you what, it's really hurt some people that they go, well, wait a minute. I thought you said if I was a real estate professional, I can offset all of let's say my spouse is makes a lot of money working for a hospital. They make $1 million. Yeah. You can only offset 500,000. So sometimes real estate professional is not a get out of jail free card. So you've got to look at the other side of it. Okay, then how do I turn my active income into passive income? So it's just, you want to always look at, the question is always, how can I do it? Not can I do it? And I think that's the question that if you're not talking that in that way with your CPA, like I always say, don't ask me if you can deduct something, ask me how you can deduct it. Because all I've got to do is change some facts and I can deduct anything. Yeah.
The real estate professional is so important. It's often misunderstood. Who's the ideal person for that? If you could just like the profile, like are they, they have enough time to do the 750 hours, obviously, but who's the best beneficiary of having that?
It would be where they make a lot of money from a business but they're not full-time at it. For example, I have doctors who make a lot of money in their practice, but they actually work more in their real estate. And so they're real estate professionals and they qualify. They might work 1,000 hours in real estate and 800 hours being a doctor, but they're just very efficient running their practice. Or you have the other one, of course, would be the one where you have a spouse that is a stay-at-home spouse. And they're going, it's 750 hours. That's it. Because you don't have another job that pays that you're working out for income. So that is also a good one. But anybody can do it as long as they spend more time at real estate. Yeah, but it's really somebody who really loves real estate.
Yeah, I'm in my head just because of the way you were saying it. I was thinking of like fire people, People with airlines,
absolutely.
obviously pilots.
Airline pilots. I've got airline pilots that are absolutely real estate
and we've had
professionals.
2 airline pilots, Steve Rosenberg and Ryan Gibson, on the show. And that it just makes sense, because what you're saying is you need to have the time to do it. And those are typical schedules where you're 2 days on, 3 days off.
Yep.
Doctors are the same. So it's really not what people think. I think they originally thought it would be someone who's, maybe at home more, but it's really about how your hours are structured for the job.
It is. And then you have the short-term rentals that you don't even have to be a real estate professional. So you don't even have to meet that test. You only have to meet the 500-hour test for all of your real estate combined. And I'm going, and you don't have to meet a more than test. So you can literally get all of your tax benefits from the short-term rentals, just like you would for long-term rentals, only you don't have to spend as much time at it. And you can I've seen people do really well at it.
Yeah, absolutely. So this has been amazing, by the way. Thank you so much. I really feel like we haven't had a full tax episode. So we're on episode 42, and this is going to really open everybody's eyes. So if people want to get involved in the Wealthability system, where would they go to start?
Very simple. Just go to wealthability.com. Just go to our website and schedule a call, and we'll take a look at prior year tax returns. And we'll let you know if we think there's a way to reduce your taxes, we will let you know. If we don't think there is, we will let you know that too.
And is that the best way to get in touch with you and work with you and your companies through Wealthability?
It is either through Wealthability, or of course, I do have my podcast, The Wealthability Show, which everybody's always welcome to listen to.
If you're getting a lot out of this episode, you better hop over and listen to that. Podcasts are such a great way of delivering information.
They are.
Because I feel like you wouldn't think, hey, I'm going to learn about accounting while I'm working out at the gym, but I like to multitask. You can with podcasts.
And on top of that, both of my books have audio.
Fantastic.
So you can always, now tax-free wealth, you have to listen to my voice for all that. For those
you switched it up for the new one?
Win-Win Wealth, the publisher, said, nah, we're going to do this one.
Yeah. All right. Good to know. Tom, it was an absolute pleasure meeting you. I really appreciate the value you brought to this, and I look forward to staying in touch with you.
It's always a pleasure, Jonathan.
Thanks so much. This has been episode 42 of Zen and the Art of Real Estate Investing. I'm Jonathan Green with my guest, Tom Wheelwright. I'll see you next week. I hope you enjoyed that episode of Zen and the Art of Real Estate Investing with me, Jonathan Green. And I just want to remind you, and this is always an uncomfortable part, I don't want you to think that I'm begging for you to like, subscribe, follow, do whatever you have to do for the podcast, leave a 5-star review. But if you like the podcast and you think it adds value in the real estate investing sphere, then just do me a personal favor. Like the podcast, follow it, share it when you can with your friends, and be so kind as to write a 5-star review if you believe it deserves a 5-star review up against what else is out there. I would really appreciate it, and I hope you keep listening.